Howdy, folks. Dr. Jeff Camarda. It is Tuesday, May 26th. A happy return to the post-long weekend grind to you all. A bit of mixed news on the market. Had a very strong day on Wall Street today. The market closed higher, well over 500 points, I think, on the Dow. Faded toward the end and kind of didn't quite cross that critical indicator from some perspectives of the 200-day moving average. But certainly, it was a strong showing, and we deployed a little bit of cash today into some of the things that we have been targeting for some time. But again, just a small portion of the cash kind of as a hedge, not really knowing what the future direction will be. And most of today's video, I'd like to read you this article I printed out from Barron's over the weekend. I'll try to maybe skip through some of it, but the title is "All the Reasons the Stock Market's Gains Are Not to Be Trusted." And we're always reminded, it says, that it's darkest before the dawn, but never that it's always brightest before the dusk. That's something investors might want to remember following a stellar week in stocks and now another stellar day tacked on to last week. By all appearances, all is well with the market. The Dow Jones Industrial Average gained 800 points, or 3.3 last week, and again up another 500 today. The S&P was up quite a bit too, as was NASDAQ. It's been the Dow's biggest gain since the week ended April 9th. And the week offered plenty of reasons for optimism. It started with Federal Reserve Chairman Powell striking an optimistic tone on 60 Minutes, and then Camarda came out with its COVID vaccine trial, which again is only phase one, but it was good for a market pop and some optimism. And states are reopening just in time for Memorial Day, suggesting it's very close to getting resuming normal economic activity. But sometimes the article says large weekly gains can be deceiving, and despite the rise, the S&P 500 really hasn't gone very far since its April peak. And again, still kind of knocking on the door. There's a couple of ways to interpret that, whether we're broken through that 200-day moving average or not, but it's kind of still stuck right about there. So Barron says from April 29th through May 22nd, the index has gained just 0.5%, less than its daily average move of 1.2% either direction since then. The market, if anything, has been going nowhere and is still kind of stuck up against their resistance level. And there's good reason for that. According to Citigroup, the S&P is stuck between two competing forces. On one hand, there's the $6 trillion of central bank asset purchases globally that have been kind of buoying up the market, creating a bid for the market, basically acting as a buyer in Wall Street parlance. On the other hand, there's the offer, which is what people are, investors like us, that are looking to buy, key to what could be a 50% drop in global earnings in 2020. For now, the bid, the buyers, the federal, the central bank stimulus is winning Citibank's rights. But we suspect that the other shoe hasn't dropped yet, for me to kind of paraphrase what they say, because that didn't really make much sense. The battle between these two forces is apparent when looking at where the S&P 500 stands in relation to its 50 and 200-day moving averages, as we've been commenting on for some weeks now. The 50-day, a short-term measure of the market's trend, sits at about 2730 and should offer the market some support. The 200-day, however, sits at about 3,000, just 1.5% above Friday's close, and offers obvious resistance and still appears to be quite resistant, not really crashing through yet. Hope it does, but certainly not there yet. So for now, one is the immovable object and the other is the unstoppable force, and the S&P 500 has been stuck trading between them for 21 consecutive days. Let's see, tack on today is 22. If history is a guide, the next move is almost certainly lower. This was just the 30th time since 1928 that the S&P 500 has remained between two moving averages for at least 20 days, according to this research by Sundial Capital. Of the 29 previous times, the S&P broke lower through the 50-day 21 times and traded higher through the 200 just 8 times, suggesting there's a 72% chance that the next move is down. And if that's what happens, there's no way to tell for sure, but we feel that we're prepared for that. It's worse than that, though. It's that even when the S&P has broken through its 200-day moving average, the index has consistently traded lower over the next 6 months with an average decline of about 13%. The trouble is basically that buyers haven't shown enough oomph to make any progress lately, he writes. When that happens during downtrending markets like we've been in, with a protracted stretch near but below the 200-day moving average, it's indicated larger problems than that has always meant further weakness ahead. And this isn't the only aspect of the market suggesting troubles ahead. Another commentator, Rosenberg, chief strategist at Rosenberg Research, broke the market down to two indexes representing the themes driving stocks now, and they show there isn't much of a disconnect between the economy and the markets as people may think. So and that will, it just continues on to mention some other risks like what's happening with these heightening China tensions and indications of flare-up and infections and areas that have opened their economies, such as in Germany, with this the so-called super spreader event in a church. A lot of people have gotten sick and so forth. So anyway, that I've droned on far too long for this evening, and I'll save further opining for tomorrow. But you may ask, with that dreary reading from the Book of Barons, why it is that we dipped our toe in the water and did some buying today. And the reason is you just don't know. And this is, as much of a hedging game, if you will, as anything else. And it could break either way. And we're trying to do our best to straddle these two scenarios and be able to take advantage whichever way it goes. So hopefully that was informative and not too dreary. And on that note, until tomorrow, thank you so much for listening to the whole thing, if in fact you did. Good evening. Talk to you Wednesday. Bye-bye.